Inflation is back above 4%. Oil is holding over $90 and tech leadership is starting to wobble just as the AI IPO wave accelerates. This is vTalkInsight, Equity Pulse Daily for June 11, 2026, where we connect the macro shock, sector rotations, and company stories shaping today's equity tape. U.S. headline consumer inflation has re-accelerated to about 4.2% year-on-year, the highest reading since 2023, driven largely by a renewed surge in gasoline prices linked to Middle East tensions. That has pushed inflation back to the center of the macro narrative and reopened the debate on whether the current rate setting is restrictive enough. Bond traders have responded by increasing bets on further Federal Reserve rate hikes, especially into year-end. The conversation has shifted toward a more binary choice, where the Fed either stays on hold for longer or is forced into multiple hikes if inflation continues to surprise to the upside. With CPI near multi-year highs and the latest jobs report still robust, markets are assigning a growing probability to a December hike, and some scenarios now push any discussion of cuts out toward 2027. That higher-for-longer backdrop matters for equities because it keeps the real cost of capital elevated and challenges stretched valuation pockets, especially among long-duration growth names. Rate expectations are also feeding into the shape of the U.S. yield curve, where investors are demanding more term premium to compensate for inflation and policy risk. A sustained steepening driven by higher long yields can tighten financial conditions for corporates and households, even if the Fed funds rate itself does not move immediately. The underlying inflation mix is uncomfortable. Energy and other supply shocks are pushing up headline prices, while strong demand, including from AI-related capex, is keeping the economy from cooling quickly. Yet core inflation is stabilizing. Recent core monthly readings have been slightly softer than feared, and both market-based and survey measures of inflation expectations remain broadly anchored, which supports the idea that the Fed still has some credibility buffer. The incoming Fed chair is expected to stay hawkish on inflation, prioritizing price stability, but may handle communication differently from predecessors. At the next policy meeting, the central bank is seen likely to drop its easing bias and explicit forward guidance on cuts, signaling more two-sided risk and a greater willingness to respond to data in either direction. This evolving macro regime is colliding with an equity market that has just come off one of the strongest two-month stretches in decades, and that had been pricing a fairly benign soft landing path. Recent sessions tell a different story, with the S&P 500 down more than 1.5% on the day of the latest CPI release, and the VIX back above 22, indicating that equity investors are starting to reprice both policy risk and growth uncertainty. Beneath the headline growth resilience, the household sector shows mounting stress, as essentials like energy and transport are rising faster than wages, savings buffers are being run down, and consumer confidence remains weak. For equities, that combination of firm aggregate data and squeezed end demand implies a more selective environment, where earnings quality and pricing power become increasingly important differentiators. Energy markets sit at the heart of the current macro shock, with escalating military exchanges between the United States and Iran testing the resilience of ceasefires and raising the risk of miscalculation. Operations around the Strait of Hormuz, a critical choke point for global oil flows, have tightened effective supply and injected a fresh geopolitical risk premium into prices. Brent crude has rebounded and is holding around the low 90s per barrel, even after bouts of volatility tied to Middle East headlines and U.S. retaliatory strikes. Global oil and gas inventories are now being drawn down at a rapid pace to offset disrupted flows through Hormuz, and those buffers are expected to be exhausted if alternative sources fail to step up. At the same time, freight costs are jumping as vessels reroute away from conflict zones in the Red Sea and Persian Gulf, extending voyage times and increasing fuel burn. That surge in shipping costs feeds directly into delivered prices for goods, reinforcing the upside risks to inflation that are already coming from the energy complex. Asia's response underscores how serious the supply risk has become, with coal demand surging, particularly in China, as countries restock and expand coal-fired capacity to secure near-term electricity supply. In the short run, that substitution helps cap oil's upside by curbing demand, but it introduces new volatility into industrial and materials markets that are tied to coal and infrastructure investment. For listed equities, this energy shock cuts in multiple directions. Producers and some midstream names benefit from stronger pricing power, while energy-intensive sectors such as airlines, chemicals, logistics, and parts of consumer discretionary face renewed margin pressure. Higher pump prices also erode disposable income, which can weigh on retailers and travel even if headline GDP holds up, adding another layer of dispersion across cyclical and defensive segments. Crucially, the market is starting to treat Middle East tensions as more than a series of one-off flare-ups, with growing recognition that a prolonged disruption in Hormuz could keep volatility elevated across both commodities and risk assets. Going forward, the durability of the strait closure, observable inventory levels, and the evolution of shipping routes will be key signals for how persistent this inflation volatility loop becomes. Against this tougher macro backdrop, corporate earnings remain impressively strong, and that has been a critical support for equities. Companies in the S&P 500 recently delivered year-on-year earnings growth of roughly 29% versus expectations closer to the low teens, with margins expanding even in a high-inflation environment. Looking ahead, consensus still points to around 24% earnings growth for the index this year and low double-digit growth next year, with analysts continuing to revise estimates higher despite the recent uptick in volatility. That trajectory has kept a medium-term constructive tone alive, even as the near-term rate and energy debate has intensified. However, the earnings engine is far from evenly distributed, with roughly half of S&P 500 earnings growth now coming from companies leveraged to AI infrastructure investment. In May, about 80% of index gains were driven by just 10 megacap names, leaving the market increasingly exposed to single-name shocks and momentum reversals. Semiconductors are a good illustration of that tension. Revision breadth in the sector has pushed to historically elevated levels and is now rolling over, signaling that the phase of easy outperformance may be fading. Price action has caught up with that shift, with the Philadelphia Semiconductor Index seeing intraday swings of around 10 percentage points and closing down roughly 7% on one of the recent volatile sessions. Yet the fundamental story for chips remains constructive in many respects, with recent supply tightening in Taiwan viewed as bullish for pricing and valuations, and fresh checks pointing to constrained availability in both logic and memory. TSMC has reported about 30% year-on-year growth in monthly sales, underscoring persistent AI-related demand, while ASML continues to benefit from its effective monopoly in leading-edge lithography tools and the pricing power that comes with it. As semiconductor leadership wobbles, a rotation is unfolding below the surface, with flows shifting out of overbought tech and into transportation, energy, industrials, and financials, including regional banks. Market watchers increasingly expect leadership to broaden toward consumer, transport, and rate-sensitive financials as earnings momentum in the original AI and commodity winners plateaus. Company moves are reinforcing that dispersion story. RBC has downgraded Nike on a slower-than-hoped turnaround, sending the stock lower and highlighting ongoing challenges in discretionary consumer demand. Meanwhile, Amazon's expansion of its less-than-truckload freight offering to all customers is pressuring legacy players like FedEx and listed trucking names, signaling tougher competition and potential margin compression across parts of the transport complex. Importantly, there is still a sizable liquidity cushion for public markets, with annual shareholder distributions around $1.7 trillion helping to absorb rising equity and debt issuance, and client flows into both equities and fixed income showing little panic so far. Even so, the combination of narrow leadership, rising volatility, and pockets of credit stress beneath the surface means that equity indices look more robust than the underlying distribution of risks. The AI investment cycle remains a defining force for equity markets, with an estimated $4 trillion wave of infrastructure spending underway across data centers, connectivity, and space-based platforms. AI-related capital expenditure is still described as being in its early innings, suggesting a multi-year tailwind for companies positioned along that stack. Supermicro offers a clear lens into both the opportunity and the strain, with the company planning to raise $7 billion of equity to fund components for roughly $39 billion of AI server orders. The stock dropped about 28% after the announcement, highlighting how sensitive high-growth AI names can be to dilution and the cost of funding, especially in a higher-rate environment. Oracle is another key player in this infrastructure build-out, with its cloud segment expected to sustain revenue growth north of 20% and overall cloud revenues projected to expand more than 50%, helped by partnerships with OpenAI and Anthropic. Yet investors remain cautious, focusing on customer concentration risk in those marquee AI clients, rising hardware and memory costs that squeeze margins, and the question of how long such elevated growth rates can persist. Further along the stack, Ciena is positioned to benefit from accelerating bandwidth needs as AI data centers proliferate, while Palantir argues that its platforms are better suited than generic large language models for complex, mission-critical enterprise and government work. In parallel, IonQ's transition from seven-figure to nine-figure annual revenues, its acquisition of Skywater, and rising government support in the United States, the United Kingdom, and China all point to quantum computing moving from research toward commercialization, with associated equity narratives gaining traction. Higher policy rates intersect directly with these themes by pushing up funding costs for large-scale data center and quantum projects and compressing the valuation multiples investors are willing to pay for long-dated cash flows. There is growing recognition that rising yields could cap further upside in some AI infrastructure names and that future IPOs in the space may be judged more on free cash flow than on top-line growth alone. The upcoming SpaceX IPO is shaping up as a crucial test, with reported institutional demand exceeding $250 billion and the deal multiple times oversubscribed. Expectations of rapid index inclusion in benchmarks such as the Nasdaq and the Russell 1000 could trigger sizable passive flows and short-term volatility, even as investors debate how to value its mix of space launch, satellite, and AI-related ambitions. A successful SpaceX listing could open the door for other mega offerings, including potential public market debuts for OpenAI and Anthropic, whose combined capital expenditure needs are seen reaching into the trillions over time. Recent roadshows have been notably short, helped by regulatory changes that allow companies to pre-gauge institutional interest, which in turn can accelerate supply hitting the public equity market. At the same time, there is skepticism about the AI credentials of some of these issuers and concern that forced buying by index funds after inclusion could lead to suboptimal outcomes for passive holders if valuations prove too rich. For equity markets more broadly, the key question is whether robust liquidity and strong earnings can comfortably absorb this wave of high-profile issuance without forcing more aggressive rotation out of existing tech winners. Stepping back, equities are navigating a complex mix of reaccelerating headline inflation, energy-driven geopolitical shocks, and a powerful but increasingly concentrated earnings cycle. Headline CPI above 4% and oil in the 90s keep Fed hikes and higher for longer rates on the table, while strong S&P 500 profits and expanding margins continue to underpin the medium-term equity story, even as volatility picks up and leadership narrows around AI and a handful of mega caps. At the same time, sector rotations into transportation, energy, industrials, and financials, together with stress signs in private credit and real estate, point to a market where dispersion and idiosyncratic risk matter more than index-level moves. Looking ahead, the key signals will be the path of energy prices and core inflation, the Fed's communication at upcoming meetings, earnings revision trends outside the AI complex, and how smoothly the SpaceX IPO and the broader mega IPO pipeline are absorbed by public markets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.